Imagine waking up to find your morning coffee costs twice as much, or your car's fuel tank suddenly empties your wallet. These aren't just hypothetical scenarios. They're the real-world impacts of commodity price swings, from the food on your plate to the gadgets in your pocket. Commodities shape our daily lives in ways we often overlook. But what if you could peek behind the curtain and understand these market forces? Welcome to the Savvy Finance Corner YouTube channel. Wealth begins with knowledge. Commodities like oil, gold, wheat, and natural gas aren't just traded by Wall Street bigwigs. They read the building blocks of the global economy. When oil prices surge, it's not just your gas bill that feels the pinch. Those costs ripple through supply chains, affecting everything from shipping to manufacturing. Food price spikes can spark inflation and even political unrest. That's why governments keep a watchful eye on commodity markets when crafting economic policies. For investors, these price movements can make or break portfolios, influencing stocks, bonds, and currencies alike. But why should you care about commodities if you're not a trader? Well, they're deeply woven into the fabric of our economic lives. They're a key ingredient in inflation indexes like the Consumer Price Index. Remember, those semiconductor shortages causing havoc in tech and auto industries. That's linked to the availability of rare earth metals. Another crucial commodity, for savvy investors, commodities offer a way to hedge against various risks. Gold as a shield against inflation, oil to protect against energy shocks, and agricultural products as a buffer against climate-related disruptions. Now, let's dive into what really drives commodity prices. At its core, it's all about supply and demand. Economics 101. When farmers face a drought and wheat yields plummet, prices soar. If OPEC decides to cut oil production, expect your fuel costs to climb. On the flip side, oversupply can send prices tumbling. But it's not just about physical goods changing hands. Major shifts in demand, like China's industrial boom or the rise of electric vehicles, can reshape entire commodity markets. Geopolitics plays a massive role too. Wars, sanctions, and diplomatic spats can disrupt production and trade routes overnight. Just look at how the Russia-Ukraine conflict sent shockwaves through grain and energy markets worldwide. Even a tweet from a world leader or a new trade policy can trigger price swings. The broader economic picture matters enormously. When inflation heats up, commodity prices often follow suit as the value of money erodes. Central banks wielding interest rates like a magic wand that influences whether investors flock to commodities or seek refuge in bonds and stocks. And don't forget about currencies, especially the almighty US dollar. Since most commodities are priced in greenbacks, a stronger dollar typically makes them pricier for buyers using other currencies. Technology is constantly reshaping the commodity landscape. The clean energy revolution is slowly but surely eating into demand for oil and coal. Meanwhile, advances in agriculture, think genetically modified crops and precision farming, can boost food supplies and temper price spikes. The race for better batteries is driving demand for lithium, cobalt, and nickel through the roof. Mother Nature herself is a major player in commodity markets. Agricultural products are especially sensitive to seasonal patterns and weather extremes. A severe drought or an unexpected frost can devastate crops, sending prices skyrocketing. Climate phenomena like El Niño and La Niña can wreak havoc on coffee and cocoa yields, affecting your morning brew and favorite chocolate bar. So how do the pros try to predict where commodity prices are headed? It's part science, part art. Fundamental analysis involves poring over reports on production, inventory levels, and consumption patterns. Oil traders scrutinize OPEC's monthly musings, while agricultural analysts hang on every word of USDA crop forecasts. These supply-demand balance sheets form the foundation for price projections. Technical analysis is where things get a bit more abstract. Traders armed with charts look for patterns in price movements. They use tools like moving averages to smooth out short-term volatility, identify support and resistance levels where prices tend to bounce, and employ momentum indicators to spot when a commodity might be overbought or oversold. But markets aren't just cold, hard numbers. They run on human psychology, too. That's where sentiment analysis comes in. Savvy forecasters keep tabs on how traders are positioned in futures markets, monitor news headlines, and even dive into social media chatter to gauge whether the mood is bullish or bearish on a particular commodity. The cutting edge of commodity forecasting lies in artificial intelligence and big data. Machine learning algorithms can crunch massive data sets, everything from weather forecasts and shipping traffic to satellite images of crop fields, to predict price movements with uncanny accuracy. Let's look at some real-world examples of how these forces play out. Take oil prices. When OPEC Plus announced production cuts in 2022, crude shot above $100 a barrel. Those ripples spread far beyond the gas pump, affecting transportation costs, plastics production, and global inflation figures. Gold tells a different story. Often seen as a safe haven during turbulent times, the yellow metal hit record highs in 2020 as the COVID-19 pandemic sent investors scrambling for security amid stock market chaos. Agricultural commodities showcase how climate change is reshaping our world. Severe droughts in the U.S. Midwest or devastating floods in Asia can send wheat, rice, and corn prices on a roller coaster ride. Coffee lovers felt the pinch when Brazil, a major producer, faced a brutal combination of drought and frost damage, sending prices through the roof. So how can you, as an investor or simply a curious observer, make sense of all this? The key is to combine different approaches. No single forecasting method is foolproof. A solid strategy blends fundamental analysis for long-term trends, technical analysis for short-term timing, and sentiment analysis to gauge the market's mood. Remember, commodity markets can be wildly volatile. If you're thinking of dipping your toes in, risk management is crucial. Set clear stop-loss levels to limit potential losses, diversify across different assets, and be extremely cautious with leverage when trading futures contracts. For most people, directly buying and selling commodity futures is too risky and complex. Luckily, there are safer alternatives, exchange-traded funds, ETFs, focused on gold, energy, or agriculture, offer exposure without the complexity. Commodity-focused mutual funds provide professional management, while investing in shares of companies tied to commodity production is another way to gain indirect exposure. Here's the bottom line. Volatility in commodity markets is the rule, not the exception. Prices will always be sensitive to shocks and surprises, but armed with the right knowledge and analytical tools, you can navigate these choppy waters with confidence. Remember, you don't need to be a professional trader to understand commodity trends. By grasping the fundamental drivers and keeping an eye on key indicators, you can make more informed decisions whether you're an investor or simply trying to understand why your grocery bill looks different this month. We want to hear from you. Which commodity do you follow most closely? Oil, gold, wheat, or something else entirely? Let us know in the comments below. And do you and T forget to subscribe for more weekly market insights that will help you become a savvier investor. Until next time, keep learning and stay financially savvy.